Is it worth, this is the question we need to ask, and I'm not answering the question, I'm asking the question, is it worth crashing the economy for a $900 billion savings? Maybe the answer is yes.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast. Hey, y'all, welcome to the Legacy Podcast. I am your host, Tim Bratz. Today I have a special guest, a guy I've known for a long time through social media, but actually connecting for the first time one-on-one here, Mr. Jay Scott. So if you're not a follower of Jay's, he's got a ton of intellect and a ton of insight on all things real estate. He was a former co-host of the BiggerPockets Podcast. He's obviously a real estate investor. He is an angel investor. He's authored 5 different books, including Real Estate by the Numbers, Recession-Proof Real Estate, and the book on flipping houses. He's a partner at Boardroom Investments and also runs the Drunk Real Estate Podcast with other friends of mine, AJ Osborne, Marisa Rawld, and some brilliant business minds. So, Jay, great to have you here, man. Thanks for being here.
Thanks for having me, Tim. This is great. I can't believe this is the first time we've actually connected over the years.
I know we run in a lot of the same circles, and it's long overdue, but I'm glad it happened. So here's what I got a ton of respect for you, and we were just talking offline a little bit before that. The relevant topic right now is these reciprocal tariffs that the Trump administration just put in place. All the economic impact that's happened over the past week and a half since then, how it's affecting interest rates, is there a looming recession? There's a lot of questions about why this is being put in place, how it's affecting the economy today, how it's going to affect the economy over the course of the next 12 to 24 months, and what is the main purpose behind all of it. And I've been following your posts. A lot of great information, tons of engagement, tons of great information on both sides. But what I realized is, man, everybody's still polarized, right? Like, you can't get the far right to come off of, Trump's not doing everything, he's this godsend and he's doing everything the way that it should be done and all these, and then you can't get the far left from saying everything, he's the Antichrist, right? And you still have this polarization in everything, and people aren't thinking. And you're one of the few people out there who's actually talking and questioning things, even though we're real estate guys. In most situations, I would say most real estate people did vote for Trump. I'll raise my hand and say I did. And at the same time, I'm like, what's going on? Why are we going down this path? And I think, my goal for this is to get people thinking, right? And thinking for themselves, as opposed to just following some blatant ideology that they didn't come up with, that somebody told them to believe in. And so that's really my goal, and to make the facts, and then let people make their own decisions from that. And so I'm not here to support Trump. I'm not here to criticize Trump. I just want to talk through why this could be happening, and then the economics behind it. You game to do that?
Absolutely. And let me start by just saying something, because I know anybody that's reading my post these days, a lot of times we're conflating economics with politics. People read that I don't like Trump's economic policy, the administration's, let's call it the administration's economic policies. Yeah. So it's not just Trump. He's got a bunch of people around him who are pushing these policies and who are integral in actually formulating and constructing these policies. And I just want to make it clear that I'm not a fan of Trump. I'm also not a fan of Biden. I wasn't a big fan of Obama. I certainly wasn't a big fan of Bush Jr. Like, I've been following politics. I'm an old guy. I'm in my 50s. I've been following politics for a long time. I haven't had a politician that I've respected, especially on economic policy, for a long time. And so, yeah, I am criticizing Trump's economic policy. Doesn't mean I hate Trump. I criticize Biden's economic policy. Doesn't mean I hated Biden. I don't know the people. I don't hate them personally, but I will give my fair assessment of their economic policy. And all I ask is people go into this with an open mind, separate the people from the policy. Because I think when you do that, when you can go in with kind of a skeptical eye, what you'll find is that sometimes people you like do things you don't like, and vice versa. Sometimes people you don't like actually do things that are really good for the country and the economy and the nation. And so I will give credit due to Trump where it's due, but I will also criticize and question where it's due.
I love that. And as you should, right? If we have groupthink and we all go in the same direction all the time, it reduces, I just read a study, it reduces creativity and it
Yep.
reduces problem solving dramatically. It's something like 40 or 50% is reduced if we're all saying the same thing and thinking in the same way. Like we need this constructive criticism in order to question these things and make sure that we're all doing what's best for the country. I think that is where we need to start out is our goal here is to figure out what is best for the American people and in the long run, right? Not just in the short term, but also in the long run. Because I'm a big believer, usually if I make long-term decisions,
Mm-hmm.
I usually make a better decision, right?
Yep.
Versus making permanent decisions based on temporary circumstances. I think people, they get their feathers ruffled in that situation. I like always thinking about what's going to be best for the long term. I understand there might be some economic turmoil in the short term, and I'm okay with that personally, but I want to make sure that that's even what's happening because I don't know if these tariffs are a means to the end of what's actually trying to be accomplished here. So
Yeah.
let's dive in. Let's start from the top and just kind of go back to a week and a half, 2 weeks ago, before these tariffs were implemented. Why are we calling these reciprocal tariffs, right? They came out with saying they're reciprocal tariffs because there's, when you say they're reciprocal tariffs, you think that you're balancing out the amount of percent that we're paying in tariffs, when in reality, it looks like it was calculated based on a trade imbalance. So can you bring us kind of from the start, let's lay a good groundwork of what does that mean? What do each of those things mean? And then let's take it and unravel the onion one layer at a time.
Yeah, and you're starting with like the hardest question first, which is why are we doing this? And I can't answer that question. I don't think anybody can answer that question, or at least anybody that can hasn't wanted to as of yet. And so if we do want to start at the 10,000-foot level, let's start there, which is Trump made a proclamation a few months ago that we are in a bad position in this country with respect to our deficit and our debt. We're $37 trillion in debt, which is about $16 trillion more than we were 7 years ago. Our deficits are running about $2 trillion a year, which means we're racking up $2 trillion more in debt every year. That is unsustainable. And Trump is the first president in a long time, going all the way back to Clinton, Bill Clinton, that has said this is ridiculous, this is unsustainable for the good of the nation, for the long-term viability and health of our economy. We need to do something about this. And that message is spot on. And I love that message. Now, then we get into the execution on fixing those problems, and that's where I start to have some issues. So yeah, it started out where what we heard was we are being punished by other countries around the world. Other countries have tariffs on us that are higher than the tariffs that we have on them. And our goal, or the administration's goal, is to even out those tariffs. So we tariff them as much as they tariff us, or better yet, they don't tariff us at all. We don't tariff them at all. And we all go move on our merry way, doing something that we consider quote unquote fair. Here we are a couple weeks into that, and the message is starting to change. First, we saw the chart of tariffs that were being released last week against every country in the nation, pretty much every country on the planet, pretty much every country. And what we saw was it wasn't really tariffs that this chart was representing. As you pointed out, Tim, this was basically trade imbalances. We saw if Vietnam, for example, was exporting a lot more to us than we were importing to them, that large trade imbalance, the fact that we were paying them more money for goods than they were paying us for goods, was reflected on that chart as large tariffs, even though they weren't tariffs. Tariffs are a tax. This isn't a tax. This is just a trade imbalance. And so for all of these countries, what we saw was the chart was labeled reciprocal tariffs. These are the tariffs they're charging. These are the tariffs we're charging. But it wasn't really that. It was the trade imbalance with each of these countries. And since then, since that's been called out by economists and media, the administration's tone has changed a little bit. Peter Navarro went on some he's one of the economic counsels for Trump, went on some news shows this past weekend and basically said, yeah, we need to get our trade balances down. And the message kind of transitioned from we need to even out tariffs to we need to even out trade. And if today China's sending us $500 billion in goods and we're only sending them $100 billion of goods, that's bad. We need to be sending them as much as they're sending us, and we need to even that out. And so one of the big questions is, what is the goal of the administration? Is it to even out tariffs and get fair trade? Is it to even out the trade balance, or is it something else? Is there some other goal that we don't know of? And I've heard various things floated. I've heard we're trying to crash the market so that we can get bond yields down, so that we can refinance a whole bunch of debt that's coming due this year. Great, we can talk about that if that's the goal. I've heard the goal is to bring manufacturing back to the U.S. That's a fantastic goal. We can talk about that and if this will make it work. We've talked about, is this a way of raising revenue? Some people have talked about, hey, if we can get $1 trillion a year in tariff revenue, maybe we can reduce taxes or we can eliminate the income tax or whatever it is. And so great, we can talk about that. The problem is the administration hasn't been forthcoming with exactly what the goals of these tariffs are. So it's really hard to have the discussion of, is this the right way to go about it? And is it actually going to accomplish what they're trying to accomplish?
And that's the question, right? Like, what's the main goal of all of this? You've seen it, right, with all the different presidential orders that they've put in place. And from the very beginning, he's put all these different things in place that have, and he said things since he's gotten in office that, we're going to make Canada the 51st state. We're going to take over Greenland. And if you've read The Art of the Deal, his book, he price anchors is essentially what he's doing. He throws out these crazy, unbelievable, gets everybody talking. Oh my gosh, this is going to be the worst thing ever. Way off the spectrum, off the screen here, with not the intent of actually achieving that, with the intent of getting, 10% or 25% of the way there. And that's how he negotiates. This is what he does and how he's always done it. And so is this a tactic in some capacity, right? He calls it Liberation Day. He's trying to get all the support of his followers in order to get behind this. But why is he doing it? I'm trying to figure out what is the main goal here. And is it just a price anchor and an expectation setting thing? And he's going to come back and then really with the intent of, hey, we don't want to get into a trade war. We don't want to get into a tariff war. Let's just wipe it all out. And then all these countries say, yeah, let's just wipe it all out. You think that could potentially be the goal?
It could be. And let me just say, Trump has absolutely amazing instincts when it comes to certain types of negotiations. I would not want to sit across from him at a real estate negotiation because, like you said, he is really good at price anchoring. All good real estate investors are going to go into a deal and say, hey, that $20 million apartment complex that you're trying to sell me, that's worth $10 million or $10 million. It's not worth $20 million. It's ridiculous. And whether that's true or not, who cares? You anchor it at 10 million. Now you got the seller saying, why is he saying 10 million? What am I missing? Maybe I can't get 20 million. And they start to have doubts. And then that helps the negotiation. Trump has amazing instincts when it comes to that. My concern is that in his world, in the real estate world, if a deal falls through, if he anchors too low and the seller basically says, F you, I'm not willing to go through with this deal, you move on to the next deal. No harm, no foul. Maybe you come back later. You burn a bridge, no big deal. Okay, there are thousands of sellers out there. Not going to be a big deal. In the geopolitical world, when you burn a bridge, when you piss off a trading partner or an ally or even an enemy, there are much bigger risks because those relationships are permanent. You piss off China, China may not be our friend, may not be an ally, but it's a relationship that will endure for as long probably as both countries endure. And we can't just because we're trying to negotiate, piss them off and send them on their own way and go find other trading partners. So we have to be thinking bigger. And maybe he is. Again, we don't know what his goal is, but one of my concerns is that he is treating the geopolitical negotiations like a real estate negotiation, where if it doesn't work and you piss off the other side, oh, well, you move on to the next deal. Doesn't work here.
That's a great point. How does that affect us not only in the near term, but also in the long term? From a standpoint of what's happened in the marketplace and how the market's responding, right? The market doesn't move based on what's actually happening. The market moves based on the idea of what might happen, right? It's based on speculation. And you saw the rates, or you saw the stock market, didn't collapse, but it dropped dramatically, right? I think the Dow was down at least 10 or 15%. I know S&P was down 10%. NASDAQ was down over like 20%. Substantially affected the markets. Interest rates, at least the 5-year and the 10-year Treasury, dropped temporarily by about 30 to 40 basis points and made some moves. But as of today, as of 30 minutes ago when we started this podcast, they were back up to the same level. Actually, they're up about 10 basis points from where they were a month ago. And so things haven't gotten better, right? Like the whole idea of these rates dropping have not really gone down. It hasn't benefited us in any way. What would you say to that? Like this whole idea of reducing or diminishing the economy in order to then drive the rates down. At the end of the day, it's $10 trillion that's resetting, something along those lines at the end of this year. Even if rates drop by 2%, which by the way, they're not dropping by that much. That's $200 billion. Right? Now that's, if your goal is to increase revenue by $1 trillion and reduce expenses by $1 trillion, that's 20%. So it's something, and it definitely helps, but it's not doing that.
Yeah, I mean, let's put real numbers behind it. So realistically, I mean, unless you get a global collapse, which we don't want a global collapse, because if you get a global collapse, then we're going to be printing trillions of dollars in stimulus like we did back in 2020. And so that's going to wipe out any gains that we get from lowering our interest rates. But let's say we could get interest down 1.5%. And I think that's a crazy, ridiculous, aggressive goal. But let's say we can get 1.5%. Like you said, about 10 trillion, maybe 9 trillion, 10 trillion. Let's say 10 trillion is coming due in the next year. So we get rates down 1.5%. We keep them down for a year, which means we're basically in a pretty bad shape, stock market, GDP, other things. But let's say we can do that. We're saving 1.5% on the 10 trillion that we're refinancing this year, which is, as you pointed out, about $150 billion. Our average, what they call average weighted duration of treasury debt, which means the typical duration of every new bond that we create is about 71 months. So on average, when we create a new bond, that bond lasts 71 months. And so you're getting $150 billion a year savings for almost 6 years, or about $900 billion. So 6 times 150 billion. Is it worth, this is the question we need to ask, and I'm not answering the question, I'm asking the question, is it worth crashing the economy for a $900 billion savings? Maybe the answer is yes, but here are some of the risks you have to think about. Number one, all it takes is miscalculating how bad we crashed the market and the economy, and now even printing $1 trillion. To put it into perspective, we printed $4 trillion back during COVID, another $4 trillion after COVID, which shouldn't have been printed when Biden came into office, but we did. But it's not tough to see our government printing another $1 trillion in stimulus if things get bad. That would wipe out all the gains from the interest rate lost. Number two, we're losing a ton of money in GDP. When we see a market collapse, when we see the economy collapse, people stop spending, businesses stop buying, they lay people off, unemployment goes up, GDP goes down. All of these things happen that the country and the world loses money. If we lose 2% of GDP a year because of a downturn, that's about $600 billion. And so it's not tough to see that like it's easy to wipe out any savings we could get on interest by purposely reducing the stock market and the bond market. And then the second piece that you pointed out is things don't always work out the way we expect. The general expectation is the stock market drops, people take money out of the stock market, they put it into the bond market, and more demand in the bond market makes bond yields drop or interest rates drop. And so the general rule of thumb is stock market goes down, bonds go down. Not always the case, as we're seeing here. Over the last week, we've seen bond yields go up. We've seen interest rates on bonds go up. And the reason for that is because people are taking money out of the stock market, but they're not necessarily putting it in the bond market right now. Maybe they're putting it into Japan's debt or currency because they trust that more than the US right now. Maybe they're just letting it sit in cash. Maybe they're putting it in gold. Maybe they're putting it into crypto. China, who holds a lot of US Treasury bonds, nearly $1 trillion in US Treasuries, maybe just over $1 trillion, they're starting to cash in bonds just to punish us for what we're doing to them.
What do they do? They just did like 50 billion.
They just did 50 billion. And so that's detracting from the demand on bonds, and that's bringing prices up. There was a treasury auction yesterday, which means the treasury said we need to raise more money, so they issue more bonds. Very few people came out to buy bonds yesterday. A lot of people are kind of in wait and see mode, and that drives bond yields up. And so this idea that you just crash the stock market and interest rates go down, a lot of times is correct, but not always. And in this case, it's not. Now, maybe you could argue if we crash the market so bad, Jerome Powell's going to step in, the Fed's going to step in, and they're going to lower interest rates. They're going to have an emergency rate cut of a quarter point or a half point, and that's going to force rates down. But they're in a tough spot too. The Fed's in a tough spot. Remember, when you lower interest rates, when the Fed lowers interest rates, that drives inflation. We're already starting to see inflation resurge from these tariffs. Tariffs are inflationary. So the Fed's going to have to make a really tough decision. Do we cut rates, which is going to spur the economy, but it's also going to drive inflation, which is going up? Or do we leave rates where they are so we don't drive inflation, but that's going to keep the economy in the tank? So it's a really tough situation right now, and your guess is as good as mine.
Well, I think, obviously the inflation is a big factor. It's one of the two major factors of, are they increasing rates or reducing rates? I do think they put way more weight on jobs, right? And what's happening with the unemployment or employment numbers, and what does that look like?
Yeah.
Have we looked out at how many of the government employees are no longer going to be on payroll as after I think September was that thing? I don't think as many people signed up for that as they thought would sign up for it, correct?
Well, it's crazy. I had a theory that in March, we were going to see massive government layoffs, that we were going to see massive private sector layoffs, and that last Friday, the day that the market basically collapsed from tariffs, I was expecting a month and a half ago that day was going to be the day that the March employment report was released. It was going to be so bad that the market was going to collapse from the bad jobs report. Turned out it wasn't a bad jobs report at all. It was actually a really good jobs report for some reason. And I don't know exactly why this is. Maybe people just, maybe a lot of government employees are getting severance. Maybe a lot of them were reinstated by the courts. But the reality is that we haven't seen a ton of federal layoffs, at least not that have resulted in unemployment claims. We haven't seen enough private sector layoffs that have resulted in unemployment claims, that we're really seeing a big movement in unemployment. It went from 4.1% to 4.2% last month, which is still a great number. And so we're not seeing that movement in unemployment. I shouldn't say nobody knows why. I don't know why. And so I still expect that as we cut government jobs, as we see layoffs in the private sector, that number is going to go up. But it's hard to tell if that's going to be this month, next month, or like you said, in September when all the severance runs out. And so not knowing where jobs are going makes it really tough to know what the Fed might do. If jobs were skyrocketing, if unemployment was skyrocketing right now, it's a lot easier to believe that the Fed's going to step in and drop rates. But right now, employment's actually pretty strong, and it gives the Fed cover for basically just sitting back and waiting and seeing.
And that's why rates, even if the economy tanked by 10 to 20%, depending on the stock market, but it only affects, what is it? Less than 20% of the population actually has money in the stock market. So
yeah, lots of people have money in their IRAs, they have money in their 401ks, they have money in pension funds and things like that. So it affects a whole lot more people, but most people, it doesn't affect them from a day-to-day standpoint. They're not looking at their portfolio. They're not thinking about how much they've gained or lost. So it does affect most Americans, but most of us don't even think about it.
Yeah, from a day-to-day basis, it's less than 10% of the population that's actually affected by it. And so even with that happening, you've got unemployment is actually pretty steady. Inflation is starting to creep up. In that scenario, the Fed actually increases interest rates instead of increasing rates.
Yeah, they're in a really tough spot right now.
This episode of the Legacy Podcast is brought to you by the Legacy Boardroom Mastermind. So our goal is to give as much free information away as humanly possible through all of our social media platforms and try to help people with their businesses, help people with their lives. We also have something for people who want more one-on-one attention, which is Legacy Boardroom. Legacy Boardroom is a board of directors for your business. If you are doing up to about $10 million a year in gross revenue, you're making some money, you got some good things happening, but maybe you can't afford a C-suite of executives, of a chief marketing officer, a chief operating officer, a chief investment officer, a chief human resources officer, and you need access to these fractional C-suite executives. That's what this was built for, at a fraction of the price of what you could find anywhere else in the marketplace. So it's my actual team who have built multiple 7 and 8 and 9-figure businesses and real estate portfolios that is available every single day of the week on these daily boardroom calls. So any questions that you have, you can hop on, ask questions about operations to my COO, ask questions about acquisitions to my CMO, ask questions about raising private money to my chief investment officer, or team building to my chief HR officer. So they're available for you 5 days a week. Any questions that you have, any hurdles that you're facing, anything that you need, these guys are available to help you break through any sort of barriers and take your business to the next level, so that way you can build a business that is designed to feed your life and your lifestyle. So if you're interested in learning a little bit more, check out legacyboardroom.com.
So there's questions on inflation. There's also questions on stagflation. Can you speak to that? Like, what is stagflation, and how would that affect us over the course of the next 12, 24 months?
Yeah, so stagflation is basically what the name implies. The stag refers to a stagnating economy or a recession, and the inflation part refers to increasing inflation. Normally, as you just alluded to, when we have a recession, we have less inflation, because inflation is mostly driven by people going crazy, spending tons of money. That's what drives prices up for the most part. And so when you have a recession, people stop spending money and inflation drops. And so that's the good thing about a recession, is that it causes a drop of inflation. And then conversely, when inflation's hot and prices are going up, it normally means that the economy is super strong, because everybody's spending lots of money, everybody has good jobs, they're making lots of money. And so normally we either have recession or inflation. Neither is great, but both of them can be handled by the Fed by either increasing or decreasing rates. The problem is when you get both of those at the same time, you get a down economy and you get inflation, that puts the Fed in a tough spot. If you lower rates, that'll help the economy, but it'll make inflation worse. If you raise rates, that'll help inflation because it'll drop demand, but it'll make the economy worse. And so the Fed's in this situation where they have to choose, do we want to fix the crappy economy, or do we want to fix inflation? Because it's really tough to fix both. And we saw this back in the 70s. That was the last time we saw major stagflation. When we saw inflation, recession, we had like three recessions between 1967 and 1981, major recessions, and we saw major inflation. And so even during these recessions, the Fed was raising interest rates to 15, 16, 18%, and they couldn't get anything done, because every time they'd raise rates, it would bring inflation down, but it would crash the market. So they'd drop rates, and that would fix the market, but inflation would go back up. And so that's the risk of stagflation, is that there's no good remedy from the Fed, and you basically just have to wait it out and hope it gets better.
What other tools does the Fed have outside of that? Like some of the tax type structures and the tax cuts and things like that. They were talking about bringing back 100%, bonus depreciation and things like that to then spur more investment from businesses. Is that a tool that's actively being looked at?
Well, keep in mind that the Fed really only has two levers to pull: interest rates and money printing. So they can raise interest rates, lower interest rates, they can print money, or they can pull money out of the economy. Those are the things they do. And basically those two things are the same. There's just two ways of doing the same thing, making it tougher to borrow or easier to borrow. Things like tax cuts, that's all controlled by Congress. And so that actually adds another layer of complexity to this. You may have the Fed saying, we want to fix inflation or the economy, one or the other, and we're going to do this thing with interest rates. We're going to either raise them or lower them to fix whatever they think is important to fix. And then you have Congress, who's making their own decisions on things like, should we be spending lots of money, which is inflationary? Should we be cutting taxes, which is inflationary? Should we be raising taxes, which is deflationary? And so one of the important things to keep in mind here is that the Fed and Congress can accidentally, I can't imagine they would do it on purpose, but they can accidentally do things that are at odds with each other, and that can make things worse. And so the hope is that when we identify that there's an issue, again, recession, inflation, both, whatever it is, that the Fed and Congress and the president and everybody can kind of come together and say, here's what we need to do. And everybody kind of makes rules and laws and decisions that drive that decision as opposed to everybody just kind of doing what they want to do.
Think that'll ever happen? Do you think, I mean, the Republicans control, obviously, the president. They control the House. They control the Senate right now, and they've got about 24 months of that. But there's just so much polarization, right? Can we ever get everybody on the same page?
Here's one of my big concerns. If you look at the two opposing sides, you have the economy and you have inflation. If the economy is down for 6 months or 12 months or 18 months, it's going to come back and things will get back to normal. If inflation is super high for 6 or 12 or 18 months, potentially it never gets back to normal. Think back to 2022 when we had 9% inflation. We still are seeing high prices. Even though inflation's come down, prices haven't come down. Mm-hmm. Groceries are still expensive and cars are still expensive and food and clothing and all these things are still expensive from 2 years ago, 3 years ago. Inflation doesn't come down. And so if you have to choose between, do we go into a recession to fix inflation, or do we go into inflation to fix recession? In my mind, the obvious choice is let the recession happen because we really don't want inflation. Here's the problem. The president really wants tax cuts. That seems to be his biggest congressional and legislative agenda, is getting these tax cuts. Tax cuts are super inflationary. And so he's going to push for, even if it goes into high inflation, that's okay. I suspect the Fed's going to be on the other side saying, no, we don't want inflation. We'd rather have recession. And so the two sides are going to be at odds.
At what point, right? Like everything's a bubble, right? Everything's cyclical. Everything gets built up and then it collapses and built. At what point are they like, we don't need the Fed, right? Just let the global economy happen. Let the market happen. The Fed's doing more damage than it's actually helping. Is it? Is it not? And is a reset needed, right? Like if you take a look at what companies are valued at in the S&P, it's 42 times earnings. It's never been that high. It's always been an average of 22x of earnings. It's 42x earnings right now, or it was right before. The economy came down a little bit after the tariff announcement, but it's like, is a reset needed, and should we just kind of let it reset? Do we let it kind of collapse a little bit and then build it back up?
Yeah. So two questions there. The first one was, what do we do about the Fed, or does the Fed back off? I think what's most likely going to happen with the Fed is Jerome Powell, who's chair of the Fed, and Donald Trump are going to butt heads for another year. Trump's going to insult Powell and say he's not doing his job. Powell's going to insult Trump and say he's not doing his job. And nothing really much is going to happen for the next year. But Powell's term is up in the beginning of 2026. And so Trump is going to have the opportunity to appoint a new Fed chair. And my guess is he's going to appoint somebody that's going to do exactly what he wants, which is to lower interest rates, which is going to lead to higher inflation. And we're going to see higher inflation. So I think Trump's just waiting Powell out and is going to replace him with somebody that will do his bidding. To the question of should we let things reset? Absolutely. Recessions are good. Over the last 160 years, most people don't realize this, we've had 36 recessions in this country. So divide 160 years by 36 recessions, and you'll see we have a recession every 4.5 years in this country. Now, the last 20 or 50 years, we haven't seen it nearly as often. In fact, we haven't really seen a real recession since 2008. And that's because we're printing all this money to keep the recessions from happening. But historically, we have recessions every 4 or 5 years. It's not a bad thing. Here's the good thing about a recession. Recession gets rid of debt. So what happens is the economy gets stronger and stronger and stronger. And that's basically people building up debt, people taking out debt on mortgages, people taking out debt on credit cards, businesses taking out debt to build factories and to hire workers and to buy inventory and to buy equipment. And so all of this debt builds up. And then you have a recession and people can't pay their debt. So people default on their credit cards. They default on their mortgages and get foreclosed on. Businesses go bankrupt and have to close their businesses. And all this debt kind of disappears into thin air. The bad thing is we've got a lot of suffering. People are losing their jobs. Businesses are going out of business. People can't buy food or pay their mortgage. That's bad. But the good thing is all of this crazy debt that was built up goes away. The banks take the hit and the credit card companies take the hit. But it's good for the economy and it allows us to reset. Problem is, since 2008, after we had that big global recession where we kind of deleveraged and got rid of all that debt, we've been building up debt for 17 years now. And unless we let that debt kind of roll off and evaporate and take the pain that comes along with that, it's just going to be worse when it actually does happen.
And utilizing those numbers that we're supposed to have a recession every 4.5 years.
Yeah.
That means we're 4 recessions in one. That is just being this pent up, not able to have the release that it needs.
Yep.
And how much worse is that going to then turn into for us?
Yeah, and we see that with credit card debt. I mean, the amount of consumer credit card debt is ridiculous. The amount of mortgage debt out there is ridiculous. The amount of business debt out there is ridiculous. And like you said, that's a great way of thinking of it, that we've basically built up 4 recessions worth of debt that we need to deleverage and get rid of in order to reset.
I just don't see, Trump's got too much ego. I don't see it happening on his watch. And he's
but
just
it's not just Trump.
Whatever.
Biden did the same thing.
Exactly.
Obama did the same thing.
They all have the same thing.
They're all going to do the same thing because that's what happens when you have a 4-year term and you either want to get reelected at the end of that term or you want somebody else in your party to get reelected at the end of that term. You know that whatever happens the first 3 years, you need to buy your way out of in year 4 so that everything's looking good so you or your party can get reelected.
Yep. How do you see this affecting real estate? How do you see it affecting, they just had the report that came out, I think it was the end of January or February, where it showed there's more commercial mortgages in default right now, serious default, meaning they missed more than one payment, 2 or more payments, and are being affected right now in the economy. People who have bridge loans that are resetting, variable rate loans that are resetting, terms, maturity dates coming due. Yeah. There's more than in 2008 out there in serious default. Now there's also more property than in 2008, so that makes a difference. So from a percentage of total properties out there and total properties in default, it's different. But numbers wise, there's more properties in default today than there was 17 years ago. How do you see what's happening right now affecting the real estate world and specifically those mortgages coming due?
Yeah, so it's a good question. Back in 2001, I wrote an article. And basically what I said back in 2001 was, if you look at the historical trends, real estate and inflation for 102 years, so from 1900 to 2002, real estate and inflation kind of tracked each other. They moved up at about the same pace, average of about 3.1% per year. 2002, maybe a little bit earlier, we started to see real estate values run away. So they went up much higher than inflation. We saw a big real estate bubble. 2008 comes along, real estate comes crashing down. And suddenly, if you look at those trend lines, they're back together again. So you go back to 2014 and over 114 years, we saw real estate inflation, basically the 2 lines tracking each other. 2014, well, real estate started to move away from inflation again. And so we're in this big bubble now where if you look at those 2 lines, you see that they've diverged tremendously since 2014, that real estate is much, much higher than inflation since 2014. So a lot of people assume that that means that we need to see a 2008 type event where real estate comes crashing down back to that trend line of inflation. My thesis was there's another option. And that other option is that real estate just stays flat for 5 or 7 years while inflation catches up to real estate. So instead of real estate coming crashing down to the inflation line catches up to real estate. And the reason for that thesis was because it was likely that we were going to see a lot of inflation, and inflation is good for real estate values because it drives rents, it drives asset prices, that there was a lot more chance that real estate wasn't going to come crashing down and it was just going to stay high while inflation quickly caught up. And so over the last 4 years, that's exactly what has happened. Real estate has essentially stayed flat for 4 years while inflation has started to catch up. We're still a couple years away from those 2 lines converging again. So the question is, can real estate kind of hold up for another couple years while those 2 lines kind of catch up? I actually think they can. And yeah, we're going to start to see some more commercial and even residential mortgage distress. We're going to see people foreclosing. We're going to see commercial properties getting foreclosed on. But I think we're going to see enough inflation over the next couple of years that we're going to see real estate propped up long enough that the inflation line catches up and we get back to a market where prices are actually reasonable given wages, given the rest of the economy. It's crazy to believe that real estate prices can stay where they are and the economy is going to catch up so that things are affordable again. But if I had to guess, and I'm just guessing, my guess is that's actually what's going to happen.
I agree with you 100% because I think there's another factor that's not being considered. It's supply and demand. There's no supply. There's not enough supply of housing for people to live in the United States today. And it's getting worse and worse and worse every single year, right? We're 4.5 housing units short. We need another 1 million a year. They're not being built, and they're definitely not being built at affordable prices either.
Yep.
Every home that's being built right now is either upper middle or even luxury type homes. The only things that we're seeing moving really in our market, I'm in Charleston, South Carolina, is $1 million plus price point,
yep.
Right? Like everything else under $1 million is pretty flat right now. And that's because, those people are very price sensitive versus the folks that are in the $1 million plus are less price sensitive and less affected by interest rates. And so because of this stress on the lack of demand, the need for more supply, I think you're exactly right. I think we're going to keep on seeing values at least be able to hold on tight until inflation does catch up. And then what happens, in a few years. And I think, I think that's a big thing that the government needs I don't know if the government needs to figure it out. I think individuals, right, should be able to figure it out ourselves with less government interaction and government regulation.
Yeah. And to put some numbers behind it real quick, I know you and I are both in the multifamily sector. There's about $300 billion sitting on the sidelines waiting to be deployed into real estate. The total commercial mortgage market is about $1 trillion. And so in multifamily. And so basically the amount of money sitting on the sidelines could absorb about a 33% foreclosure rate in the commercial market before we saw demand wane and basically values drop considerably. So there's the numbers kind of support what we're talking about.
I think there's going to be a big, to your point, there's so much still demand for multifamily housing, for commercial real estate, and there's so much money on the sidelines that I just don't see values dropping that much. I think the play there, what I'm seeing right now is this kind of rescue capital. Right?
Yeah.
Where they come in and they say, hey, your equity might get wiped or majority of your equity might get wiped, but I can come in, I'll step in, I'll clean up I'll make sure that you don't get foreclosed on. I'll make sure that the loan comes back into good standing, save your reputation. Mm-hmm. Let me bring a couple of bucks in the capital stack. It's almost like a mezz debt where they come in or a pref equity and they're at a low enough basis where they feel good that they can ride this thing out for another 2 to 5 years and pump it up and get the stability in operations happening where now they're in a position to take over this asset. They can get majority of the ownership in the asset. And it's a way to get into deals today that usually that's hard to find deals that way. I see there's a massive opportunity for that. And we just opened up a debt fund because of it, of all the people knocking on my door saying, hey, can you help me out of this project or that project or whatever? So it's going to be interesting to see.
Yeah, we opened a pref fund, a pref equity fund about 2.5 years ago. And at the time people were like, what's a pref equity fund? What does that do? What do you need it for? Why are you bothering? And over the last couple of years, as you said, it's become pretty clear the value there. And so I think it's a great opportunity.
Yep, very much so. So let's close out with this. We're talking about a lot of external factors. We're talking about a lot of things that you and I don't have control over. Yep. I'm a believer that let's control the controllables, right? Like 99% of our problems and our successes in life are not based on who the president is, are not based on who's in Congress, are not based on what's going on with the economy or any of these external factors. It's based on how we respond to these external factors and how we can overcome, how we can self-improve, how we can then make ourselves better and control our economy. If we can control our microeconomy and everybody does that and they take ownership over that, I think it's going to help the overall economy. What what are some things that people can do who can be empowered, right, by certain different aspects? What would you tell folks to do with their retirement accounts, with their stock holdings, with their real estate holdings? What can they do to better control their circumstance and their situation, regardless of what happens with tariffs, inflation, stagflation, monetary policy, and all those other things?
Yeah. So, I mean, first, we don't know where things are headed, but unless you think this is the end of the US experiment, unless you think that our economy is going to go down the tank and never recover, which I don't believe that's the case, and we're all hopeful that's not the case. I don't see any reason why it would be. Unless you think that's going to happen in 2, 3, 5 years, we're going to be looking back and we're going to say, okay, that was a crazy time. And look, everything's bubbling again. And so kind of think in terms of longer term. I know a lot of people back in 2008 were so terrified that this recession is never going to end, and this is going to be a forever thing. And so they didn't invest. And here we are. I mean, it was 3 years later before 2008 was in the rearview mirror and nobody thought about it again. And so that's going to happen again. So, so think long term, number one. Number two, during this short term, diversify. Don't put all your eggs in one basket. Don't put all your money in the stock market. Don't put all your money in bonds. And this is good for anybody that's not a professional investor. You should be diversifying anyway. Get into alternative assets. I love real estate right now. And I don't just say that because I'm in real estate. It's the other way around. I'm in real estate because I believe that. Real estate is the single best inflation hedge on the planet. If you believe we're going to see inflation over the next several years, and I firmly believe we're going to see high inflation over the next several years, maybe the rest of this decade, real estate is the place to be. And so diversify into real estate. Not saying put all your money into real estate, don't put all your money anywhere, but be open to these alternative assets. Be open to things that you might not have considered investing in before. Invest in commercial, invest in residential, but also diversify into other asset classes. Own some gold, maybe own some crypto if you're willing to gamble a little bit. But diversification is good. And then last thing I'll say is try and hold some cash. There's going to be opportunities. I don't know if those opportunities are going to be next week, next month, next year, 3 years from now, but at some point, there's going to be some great opportunities, and having either cash or access to cash, if you're a syndicator, start building those relationships with your investors again right now, because at some point soon, there's going to be opportunity and you want to be able to jump on it.
I agree 100%, man. I think those are great takeaways, great action items that anybody can then implement in their own life and in their own business to then, create stability in uncertain times, which is what we're looking to do here. So, Jay, this has been awesome. So many good takeaways, so many good nuggets. I got pages of notes over here while you're chatting. So, man, I appreciate you taking the time and being here. Guys, if you are not connected with Jay on social media, where's the best place for them to follow you?
Yeah, so I'm J Scott Investor, just the letter J, Scott Investor on all social media. You can go to jscott.com to get all the links. And yeah, check out the Drunk Real Estate podcast if you want more deep dive into economics and real estate and politics from a bunch of guys that are a lot smarter than I am.
Really, really brilliant group of guys there, and really good people too, right? And so sometimes you get some good guys who are, not looking out for your best interest, and sometimes you got good guys, but they don't have all the answers or all the insights, or at least aren't asking those progressive questions that lead to those good answers. You guys have the full package. A lot of really good people, a lot of really smart people on that podcast. So make sure you guys check that out. We'll share it in the show notes. And Jay, man, appreciate you being here. Thank you again.
Thanks for having me, Tim.
Hey, well, thank you for being here. Hopefully you got a ton of great value out of this episode. We try to give as much free value as possible across all of our social media platforms. So please make sure that you're connected with us. We are at Legacy Wealth on YouTube. We are at Tim Bratz on all other social media platforms. And we're available anywhere that you listen to podcasts. The best way that you can support this podcast is by just subscribing to our YouTube channel, by liking the video, by commenting on it, and by sharing it with anyone else who might get some great value out of it. So thank you again for being here. We'll see you next Sunday on the Legacy Podcast.